Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Matt Patterson, co-founder of Handle's Indexes, to discuss the second ETF based on a Handle's index, the Nasdaq FiveHandle Index ETF. For background, the Nasdaq 7-handle Index ETF launched in January 2018, and it's raised more than $1.6 billion in assets under management. Matt is back with us to discuss the newest addition to the Handle's Indexes and lineup and the investment outlook for income investors. Matt, it's great to see you as always. Welcome back to Trade Talks.
Thank you, Jill. Great to see you again.
Great. And for starters, tell me about the new Nasdaq 5-handle index and what it's designed to do.
It's a multi-asset index that is designed to support a 5% targeted distribution rate over time. From a composition standpoint, it's effectively the same index as the Nasdaq 7-handle index, except that it does not assume the use of leverage. It's an unlevered version of that same index. And the way we create the index is we split it into two different components. 50% is what we call the core portfolio, and that's allocated to low-cost equity and bond ETFs that provide investors with broad exposure to those markets. And then the other half of the index is what we call the Nasdaq Dorsey Wright Explore portfolio. And that consists of one ETF from 12 different income-oriented categories that investors have traditionally relied upon to earn high distributions. And those include things like REITs, covered call funds, dividend equities, high yield corporate bonds, and investment corporate bonds, and so on and so forth. And those 12 ETFs are rebalanced on a monthly basis using a proprietary Nasdaq Dorsey Wright algorithm. And the result is, what we hope, is an index that will deliver high risk adjusted returns sufficient to support a 5% managed distribution over the long period.
So Matt, we've seen the broad equity markets sell off to start 2022, certainly a lot of volatility there. How have other income-oriented investments performed so far?
The month of January was a pretty bad month all around. The aggregate bond index was down 2.1%. That's kind of a replay from the first quarter of last year. Of the categories that are included in the Handles base index, only one category earned positive returns in the first quarter, or the month of January, and that was the MLP category. For investors who have been in MLPs for a long period of time, probably at the beginning of 2020 or 2021 even, they could be forgiven for being frustrated by the category. It went the better part of a decade without earning positive returns. But in the month of January, MLPs were up 11%. Going back to February 1st of last year, the one-year performance for MLPs has been 47%. And obviously, they have ridden a wave of higher oil prices. But I think the lesson for investors is that MLPs can be a very valuable diversifying component of a portfolio. It's great to have a category that delivers positive returns when virtually every other category is in the negative. On the equity side, what we saw, generally speaking, is that those investing areas that had more sensitivity to interest rates generally underperformed the S&P 500. And so that includes the tech-heavy QQQ, but it also includes REITs, which are very interest rate sensitive.
What questions are income investors facing as we look forward to the rest of 2022?
I think obviously the number one question on people's minds right now is inflation. We just saw a 7% print on the CPI in December, and I think for most of us, we have no recollection of ever seeing something like that in our lifetimes. I think that silenced a lot of the people who were arguing that inflation is transitory and can be expected to quickly subside. But the flip side of that is that the bond market doesn't seem to think we're going to be seeing sustained 7% inflation. for a long time. If you look at the 5-year U.S. Treasury, it's around 1.7%. The 10-year isn't much higher than that. The inflation rate predicted by the 5-year break-evens market that you can apply from the market for tips is about 2.8%, which is historically very high, but significantly below what we're actually seeing in the CPI numbers. And, there's a lot of counter arguments to that. We could question whether interest rates will remain low if the Fed is no longer regularly purchasing treasuries. But I'm not inclined to bet against the bond market. There's a lot of money at stake there, and currently it's expecting inflation to subside somewhat. The other big issue in 2022 that should be on investors' radars is the midterm election. That one's a little bit easier to predict than what's going to happen with inflation. If you look at the odds makers, they're giving the Republicans a 70% chance of winning control of both houses of Congress. And I think what would result then would be gridlock. And what we've learned in the past is that the markets often respond favorably to gridlock, particularly when it's a Democratic president and a Republican Congress. So that, at least I think, should not be expected to provide headwinds for investors.
Right. And Matt, in the last minute here, what advice do you have for investors seeking income in this environment?
Sometimes I feel like a broken record, but, we like to emphasize that investors need to focus on total return. Too often investors get caught up in high dividends or yields, and they focus on clipping the coupons. But if you talk to any investor in AT&T over the last 5 years, yes, they've had a lot of income and they've made no money over that time. Ultimately, the amount of income you're going to get from your portfolio is determined by its total return, and you should be focusing on maximizing that given your risk constraints, rather than chasing yield or going into esoteric categories that have a lot of risk. And then the other thing for income investors is that it's just a reality that most people do not have sufficient assets to where they're going to be able to live off just the interest or dividends from those assets. Most people are going to enter into a drawdown phase of their lives where they not only live off their income, but they actually start to consume some of their principal. And those folks need investment solutions that let them do that in an orderly fashion while also minimizing the risk that they're going to run out of money. And we think the ETF of ETF structure is extremely useful for that. It allows funds to pay out a targeted distribution in a tax efficient manner, while also rebalancing the portfolio on a regular basis and keeping investors in the same perspective from a risk perspective.
All right, Matt, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.